Right everyone, warm welcome to this video. We're going to be breaking down how you can get the data every single Friday to see how hedge funds and the investment community are positioned in the gold markets for buying the precious metal. Okay, this Excel spreadsheet is also going to show you how you can get the data for trading other commodities like oil, for an example. So when you're trading commodities, you can know whether the professional markets are buying the commodity or selling the commodity and how many contracts are going up or down towards that level of buying or selling in the markets. Very powerful. A lot of people don't understand how the COT report gives you this data, because if you are trading anything, you need to know how the big institutional money is investing to be on the right side of the market. So enjoy this video. All right, everyone. So in this video today, I'll be breaking down why gold is reaching record highs based on the market's expectations for the Federal Reserve to cut interest rates. I'm also going to introduce you to a spreadsheet where you can see how institutional money is positioned when you're looking at the precious metal gold. And I'll show you some other metals like copper, oil, for an example, in the commodities markets, because basically you can see how hedge funds are buying these major commodities. Okay, so first things first, what drives gold? Well, this Bloomberg article, which I just had up today, says gold erased a weekly decline as traders assess the latest US data and their bets on the size of the Federal Reserve's expected interest rate cuts. Okay, and it's interest rates that drives the commodity. So I can literally show you how this plays out throughout history. And a really good example is since the Federal Reserve started raising interest rates in March 2022, when obviously COVID was out of control, inflation was high all over the world. So March 2022, the Fed raised interest rates. Notice how when the 10-year government bond interest rate started to go up from this period here, so the rate was paying 1.5% and it jumped up as the central bank was raising rates. Notice how gold slumped during that period of time, down around 20%. Soon as the 10-year government bond declined during this period here, gold then jumped up by around 30%. And then as soon as the 10-year government bond went up again, gold went down again. So there's clearly a relationship between higher interest rates on government bonds and lower gold prices. And then since October, interest rates on government bonds have been declining again, and gold has ripped higher yet again as interest rates on government bonds decline. So why is there a relationship between interest rates going up, gold going down, and when interest rates go down, gold goes up? You have to understand, gold is a hedge against inflation. Investors would always rather buy government bonds because you're guaranteed to get your money back from the US government and earn interest. Okay, so as a 10-year government bond interest rate was going up during the high inflationary period of 2022, it just meant that bonds were giving more protection for investors over inflation. And when interest rates go up, inflation will go down. So that interest rate should protect your money. Okay, so this makes bonds more attractive and gold less attractive. Soon as the interest rate on government bonds starts to go down, and I'm going to show you what drives this 10-year government bond interest rate going down. The reason gold goes up is because there's less protection from inflation when the interest rate on government bonds goes from, say, 4% down to 3.1%. Okay, and then obviously if the 10-year government bond keeps going higher, then there's more protection, and that's why the demand for gold goes down. And then obviously since here, October, we've had a decline in government bonds paying less interest over inflation, and gold has surged. Okay, so the important lesson to understand is this: you only buy gold as a hedge against inflation if government bonds are paying less protection, and you only buy government bonds ahead of gold if interest rates are going up. So right now, the bond market is pricing in interest rate cuts by the Federal Reserve. This is why the 10-year government bond is going lower, okay? And it follows the interbank rate. And here we go. Here is the central bank's interest rate in America, meeting by meeting going into next year. Rates are at 5%, and they're expected to fall to 3.3%. So think about that. If interest rates in America are going to 3.3%, and inflation in America next year is going to be around what level? Around 2%. It's currently around 2.5%. Okay, I can show you right here the exact level if we're looking at the US economy. What is the current rate of inflation in America today? We can clearly see right now it's around 3% to 2.5%, depending if you're looking at core or headline inflation. So government bonds right now are not paying that much protection. You're getting around 1%. This is why when the 10-year government bond is falling, meaning there's less interest to protect your money from inflation. Investors don't want to buy government bonds because who wants to earn 1% interest when you could buy gold, which could jump up at the exact same time by 45%. Who cares if you're getting 2% inflation if you're making 45% return? You're making 43% protection on your money, right? So this explains when government bonds are going higher, more protection from inflation, the demand for gold goes down. But as soon as you get interest rate cut expectations coming into the market, when markets know the Federal Reserve's cutting interest rates, so government bonds are going to pay less protection over inflation, this is why you get gold jumping up 40%. Okay, so that's all you need to know. If you want to know the direction of gold, you need to know where interest rates are going. So this is the spreadsheet that I teach to my members who take my online courses. We break down the US economy, understanding the fundamentals, but then most importantly, you need the interest rate expectations to understand where interest rates are going. So right now, the markets are predicting the Fed's going to cut rates. So the 10-year government bond is going to keep declining, which means gold is going to continue to rise to record highs. That's why the report says to you, gold erased its earlier declines, which was just here. Gold had a little period for a few days where it went down, but then some jobs data came out, which kind of supported the Fed needs to cut rates. So gold rebounded straight away. That's why gold's at record highs in history right now because of lower interest rates pushing up the value of the metal. This is why, if you understand about the COT report, which is a beautiful spreadsheet which you can use to understand exactly how hedge funds are positioned in the markets, because the COT report, which is released every Friday, is basically telling you how many contracts do managers, investment managers, have for long positions, short positions, and then most importantly, what's the net positioning? Is it positive or is it negative? Okay, so this report comes out every Friday. If you scroll down on this spreadsheet, you're going to see a link. If you click on the hyphen link, it's going to open up this section of the website. Okay, you need to download 2024 Excel. Okay, you're going to get the spreadsheet downloaded to your laptop. You're going to download it, open the files, okay, and it's going to look like this. Okay, and basically you're exporting from here the relevant data you need to create this part of the spreadsheet. Now, how you interpret it is very, very simple. I'll be showing you in a video, a private video, how to get the data, how to upload the data onto the spreadsheet so you can download the spreadsheet yourselves and use this to understand how many open interest positions are there on gold, how many long positions are there on gold, how many short positions are there on gold. So obviously long positions are how many asset managers are buying gold compared to how many asset managers are selling gold, and the total amount of contracts that are open, okay, for the positioning. Now, obviously, if you got 18.9% or 16%, that means there's more positive positions than negative positions. So managers are bullish on gold. So if you scroll down, you'll see as we go down into 2014, 15, 16, 17, 18, okay, into 2024, right now, managers are 37.3% bullish on long contracts compared to short contracts. So the asset managers, investment banks, hedge funds, okay, they are positioned a lot more to be going long gold than they are to go short gold, okay? If the number was negative, then obviously the more short contracts open than long contracts. So this data on a week by week basis is going to show you whether the contracts are increasing to buy gold or decreasing to buy gold. And you're always going to understand what is the net positioning. Now you can use this for gold. You can use this for copper, for an example, silver, Brent crude, and all you're doing is 0 represents the barrier between being long contracts or short contracts. So anything above 0 and growing obviously means long contracts are building to buy gold. Anything below 0 and contracting in the net positioning is obviously going to tell you whether short positions are building over long positions. So right now they're very bullish on gold, and this chart basically is highlighting the net positioning. So every Friday when this data comes out, I'll show you how to get the numbers, update the spreadsheet, and you will know how hedge funds are positioned in gold. You'll also see in copper, they're bullish on copper at the moment because copper and gold move together because they're both commodities driven by growth in the economy and demand, okay? Silver is bullish as well. Crude oil right now is bullish as well. Okay, so if you're trading commodities and you want to understand, number one, what's driving things like gold, well, now you know it's all to do with interest rates. And all you need to understand to be able to trade gold is, number one, where are interest rates going, which is what this spreadsheet really teaches the course members that understand this. But most importantly, if you don't want to have the course to do it, well, what do you need? You need to know how the hedge funds are positioned. And this is where this spreadsheet over here will come in for you, where you can literally update it every single week and know what is the net position of gold, silver, crude oil, copper. So if you are trading long-term or day trading, whatever, you have the data to know how the professional markets are trading. Okay, so at this moment in time, as we stand, the markets are predicting a lot of rate cuts by the Federal Reserve. So we should expect gold to keep marching higher, as it is right now at record highs throughout history. It's at the highest level that gold's ever been, and is driven by lower interest rates. The bond markets are going to keep pricing these rate cuts, which will push the commodity higher in the markets. Okay, if you want to get your hands on the spreadsheet, all you have to do, click the link below the video. It will take you over. Okay, and you can get your hands on the spreadsheet. There'll be a private video there showing you how to update it. It's really easy. Okay, it takes about 5 minutes every single week, but you're going to know where the institutional money is positioned if you're trading gold. So if you like the video, please like, comment, and subscribe. Okay, and hopefully this helps you if you're trading.